Yo, what's up, guys? It's your boy Looney. Today, I want to talk about something every single investor has to deal with at some point, and that is the psychology of watching your portfolio go down. And just for some context, today the market for myself or my portfolio was slightly red, not necessarily crashed, not panic mode, just one of those days where you open your account and the number seems to dip. But before we get into this video, quick shout out to the Discord. It is free to join, and I also offer a premium membership for $8 a month, and it gives you access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links that are in the description. Now, here's the truth. Red days test your mindset way more than green days. When everything is going up, it's easy to feel like a genius. But when things go down, even just a little, the emotions kick in. Fear, regret, doubt. And if you don't manage that psychology, you'll end up making the exact mistakes that blow up portfolios. So let's break down what's going on in my portfolio that was actually down. I can't even tell you what truly is down. If we go to my stocks, they were slightly red. I opened a SL and H position down 8% and open overall down 8%. It shot up and then quickly went down. So I'm used to this red. I mean, these are the only two red positions in my portfolio right now, or at least on the stock side, and I'm not panicking. Same with crypto. Crypto is slightly green and some of my positions are still red. Now options, these ones are a little bit more risky, are down. They're down today. And again, I'm not panicking with what's going on. Red days are normal. The stock market has never gone up in a straight line. Volatility is the price of admission for long-term gains. If you can't handle seeing your account go down a few percent in a day, you'll never be able to stick around long enough for compounding to do its work. Now, emotions can trick you. Our brains are wired to feel losses way more than gains. It's called loss aversion. See, losing $100 hurts way more than the joy of making $100. And that's why beginners panic sell at the bottom and then watch the market rip even higher next week. Now, overall perspective is everything. So although I am down on the day, if we zoom out on the week, I'm green. On the month, I'm up. And year to date, I'm still up. All time, still up. So perspective is everything. When you zoom out, a slightly red day is just a blip. If you've been investing for years, today won't even register on the chart. Now, if we go back to April, yes, that was a massive dip. But again, I wasn't panicking because I was very long-term mindset. Now, another thing is I have been buying these positions, and that's why I wanted to mention April, because I have been buying a lot of these when there's a lot of fear in the market, when everyone was truly panicking. Because back in April, with the tariff talk and other economics going on, the entire market was in a major sell-off and everyone was panicking. So I scooped up shares of Riot and SoFi. Well, there's a few other positions as well, but I want to just note those ones because even if this goes down 30%, I'm still up 70%. So I'm not even concerned if there's a pullback. If there's a pullback, that's actually a pretty healthy place to be in. And if I'm selling covered calls, I actually want the stock to go down slightly. So I don't mind pullbacks. I think pullbacks are good. And if it does go somehow down almost 80%, I'll just buy up more shares. I mean, Riot is definitely one of those stocks that has the hype and then runs back down. I don't know how far it'll go down. I'm not sure if it'll ever go in the negatives or go under $9, but we'll see. You never know. And if it does, I'll just buy more. I'm not here to panic. I have a very long-term asset, and I know the potential of my stocks. And that's what I want to get into the next point, is have a plan. So the best way to avoid emotional decisions is to set rules before the red day happens. So for me, that's why I dollar cost average into names I like. I'm selling the options on the side, and I'm keeping cash ready for those dips. Because when I see slightly red days like today, I don't feel pressure. I truly just see opportunities. Now, I posted about Riot on my X, if you guys want to follow me. It should be in the description, but I posted about Riot and everyone was saying they wanted to get in. because I mentioned that it's up 50% in just the past month, while everyone is talking about iron and other names. And that's why I talked about the other video before, where everyone's talking about 1,000% gains. And people are asking, like, should I get in? Is it too late? Now, is it too late? No, but that doesn't mean you should be going all in. See, look, I opened new positions. The new positions are open and SLNH, both very volatile, risky plays. That's not the important part, but the important part is the size. I'm only putting 0.43%, and this one is a little bit bigger, 2.5%, because this one's developing a little bit more. So if it dips even harder, I'll continue to dollar cost average. See, this one is very new. I know I opened this one up, I believe, today. So my game plan is simple, is to keep buying. Yes, you do run into a situation where you could run into a falling knife, but if you have that conviction and you truly understand the company and you believe in the company long-term and you have a long-term mindset, and as well as a risk allocation that is appropriate, then you shouldn't be worried about these pullbacks. And that's exactly what's going on. Most of my portfolio is green. I'm not buying heavy. I'm not massively buying the tops. I already did that way back when everyone was panicking. Maybe HIMS is the only one that I might see a little bit of a buying opportunity. So I've been buying up some shares there, but even still, not heavy. And if it does continue to dip, I will just buy more. So the final thing I want to just put out there is that red days can actually be healthy. They reset valuations and they shake out those weak hands. Because if you do see a dip, the beginners will sell out immediately, or the ones that are just there for a trade, they'll be in and out. And if you believe in a company long term, you actually don't want those people to be invested into what you have, because any day they could just be out without any kind of loyalty, which is fine. That's a fine strategy. But if you have a long-term investor mindset, you're looking for those better entry points. Without red days, there's actually no real opportunities. So just to wrap this up, red days are perfectly normal. They're part of the game. Emotions will lie to you. Don't let fear control your trades. So today I actually made a trade. I made a trade on TSLL. This one went down significantly, down really hard. And I was not panicking. I was actually thinking of doing more. I was thinking of doing another trade. And I didn't end up doing it because I didn't see the return I liked. So I didn't do it there. But that was my mindset. If it kept dipping, I was like, okay, this is a better opportunity. It's getting a better opportunity. But I just stuck to one trade, 12.5 sell put. I gave that out to my Discord, another one of those trades that I do give out as soon as I do them. Now, the third point is to zoom out. Today won't matter in 5 years. And that is really true, because on the year, even a massive dip like we saw in April was quickly bought up. And I'm up 47% in just the past year. Now, the last point is very important. Stick to your plan. Whether it's dollar cost averaging, selling options, or holding cash, always have that strategy. If you can master your psychology on the red days, you'll be way ahead of 90% of investors out there. Green days don't build discipline. Red days do. Until next time, peace.